Welcome to today's podcast. I have Jorge Gomez, CFO, MarketBox, Tax and Accounting. Hi, Jorge.
How
are you?
I'm good. Thank you, Edgar, for the invitation.
Tax season is looming on us, and we have a tax expert here. And one of the things that you mentioned to me earlier, which was super awesome, was the fact that people usually think about just saving money on taxes, but not necessarily leveraging themselves to put money back into their business by doing the taxes the right way.
That is correct. As we all know, the government is your partner, really. Especially in California, it's around 30%. And, saving money on taxes is great. You have more money for you, for yourself, for your family. But the idea when you are in business is also using the tax laws to advance your financial goals. It means, and for the small business, having access to capital is very important. And the banking industry relies on tax returns. So what do we do to achieve the best goal, which is having access to capital, we're paying the minimum amount of taxes? Correct. That's when tax planning comes. So not only for savings, but for financial growth.
Yep. And one of the things that I look at when we pre-approve somebody, because I do the lending piece, is what income we can use. And unlike most other situations where most people think I go off the gross of what the business makes, we go off the net. Well, one of the lines that we can add back is depreciation.
That is correct. Depreciation is a non-cash deduction, so the banking industry accounts it as a cash flow. So if you have an investment, it's not the same like you spend the money, or they're different with investments, because the investment counts as cash flow, because you're going to have different benefits in the future. So that's really good. We plan. The problem is during tax season, it is too late. Because the year's already passed. So the idea here is to plan for the future and be ready by the end of the year.
So you gave me some pointers, and you mentioned there's 4 top strategies for a business owner for tax deductions. What are the top 4 strategies?
Well, the 4 top that I consider is first investment in equipment, because we can get the depreciation there. But I say to my clients, only if it makes financial sense. You buy the equipment, or you can buy vehicles and invest in that, and then you get a tax benefit, which is depreciation. You reduce your taxable income, pay less taxes, but at the same time, that investment basically count as cash flow if you want access to capital to get a loan.
Good. What's another one that you think is important?
I think another one that is really, really important is when you have a commercial property. It also is related to depreciation, but it's mostly to do a cost segregation study. It's a powerful tool because it allows us to depreciate the building in a shorter period of time. This is related to the value of money. $1 today is more valuable than $1 in 30 years. Right? So let's say you have a commercial property 39 years, you get a minimum amount of depreciation. So what is a cost segregation study? Well, basically an engineering study that dismantle the building in their components: electric, plumbing, construction, you name it. So, and then we can take those components and accelerate depreciation 5-year, 15-year, and then the rest in the remaining life of the assets. So we get a huge amount of depreciation at the beginning, generate the tax savings that we need, and at the same time, we can, save a lot of money in taxes. And if you don't use the whole amount of deduction, you can carry forward.
Carry it on for
yes.
That is. What are the things you think are important for business owners to know?
For business owners, also, if you have, for example, some process that is have innovation, we can use something what is called research and development, and you can get a great deduction for that. On the salaries that you spend on the innovation, on the supplies and all that, we can get a credit for that. Also, for the business, basically, structuring properly the expenses for the owner, let's say when they spend on meals, on travel, on entertainment, that can, if you structure right, that could be income for you, but you take the deduction for at the corporate level. And many others, you can have tax strategies related to employment too. If you hire certain people in certain groups, you can get money back from the government. And one thing that I like to do, especially in California, is to combine federal and state, because states have also their equivalent, those deductions, and you can save a lot of money, especially in California.
That's smart. So let's say I don't own a business, I'm just an individual. what things can I do personally to be able to save money or prepare myself to grow money for the future?
Okay. Well, that depends of I would say on the income, but the most traditional ones is retirement. You know, planning for your retirement. Here, is pretty set the deductions that you get. I think the key here is work with a financial planner to maximize the earnings and that money, right? That's one. And then the traditional credits like child tax credit, you know, earned income credit, all those type of credits that you get for saving money too. And then when you reach certain level, let's say $500,000 or more, I would say probably 350 or more, then we come into play with different strategies that are more, they have a financial strategies that have a really huge tax benefits. We can structure entities, well, traditionally trusts, things like that, but you can do investments and take a huge deduction through charitable giving. We can plan for charitable giving. You know, it's different than donated to a non-profit. Here is more structured in a way that you can also direct where the money goes and how to invest it.
Yeah, so I know that when you're lower income, we can do IRAs. You can make sure you try to maximize your 401ks and all that good stuff.
Yes.
But what's the limit now for IRAs for individuals as far as income and maximize the?
Well, the IRAs, I think $6,000 for this year. For 25 or tomorrow, I don't know the exact amount, but I think it's 6,000. And then at a certain level, it's starting to phase up. I don't have the exact number right now, but it's different if you're single or married. Right. But high income individuals, the deduction gets phased out. Yes. Yeah.
So I mean, this is obviously super important, and I mean, I would always recommend to meet with some professional just like yourself, because, and not to obviously downgrade anybody that just does taxes. They're not necessarily out there to look for your overall picture. I would recommend a tax professional like yourself, somebody that looks at the overall picture and is looking at not necessarily just filing your taxes, but help you grow your financial picture. So, I mean, I commend you for learning all this stuff, because not a lot of people know what you know.
Well, it is really, 22 years working in this field. Also, if you look taxes to save money, like most taxpayers do, would get bad advice. You don't report properly your income, your take deduction that you're not supposed to take. But the tax code is full of opportunities for everyone to save money on taxes. And you have to see it holistically. If it doesn't make sense financially, we have to compare. If the tax savings yield a lower amount of benefit than a financial investment, sometimes it's better to pay the tax.
Yeah, I agree. Especially when you're buying a house, guys, because that's what we do. So if we see appreciation increasing the way we're seeing, make sure you meet with me so I can make sure I refer you to somebody like him, so we can figure out if it makes sense to pay the tax to be able to buy that house and see the appreciation. Sometimes that's going to help offset what we're seeing right now, inflation, so that you can see your money grow in a different way. So
that is correct.
Thanks, guys, for coming in. Thank you for coming, Jorge.
Thank you.
We'll hope to see you soon.
Thanks.
See you guys.